Welcome, everybody, to the January market update featuring the expertise of Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide. Our distinguished speaker today, Mike Ott, brings a wealth of experience to the table with a background as a former public school teacher and an impressive double-digit tenure in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him to both clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update an indispensable resource for agents seeking to stay ahead of the curve. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded and sought after trainer with us further underscores his expertise. So please join me in extending a warm welcome to your presenter for today, the one and only Mike Ott.
Hey, thank you, Cindy. Good afternoon, everybody. Happy New Year. Welcome to 2025. Let's jump right in. All right, we start with rate ranges. Where are our different programs? Overall encompassing note here, we're going to look at the mortgage-backed securities chart here in a second, like we always do. Rates have risen basically at a kind of a steady clip since December 6th. Just last week, we saw some reprieve. We'll see that in the charts. But overall, the trend has been going up and up and up, where we're now breaking through, 7% to 7.5% on a conventional conforming loan. When you jump to the high balance or the jumbo space, that range shifts to about 7.25%, 7.75%. Our Govy products, the VA loan, about 6.5% to 7%, and then your FHA and USDA rural housing, 6.75% to 7.25% is kind of the range. I always plug mortgagenewsdaily.com. It's a place where you can kind of track the national averages across the programs. You don't have to subscribe or pay. It's a free website, and it's probably the most accurate free website for this kind of data tracking and national averages. I know Freddie Mac does it. People always ask me, like, do you pay attention to Freddie Mac? I do, but Freddie Mac is always a week behind, right? So when you get the rates, they're giving you the rates for the previous week ending on Thursday. And for those of you that have been here, we talk about how the market can shift in a matter of minutes, hours, inter-day changes when things are volatile. So it's tough to kind of follow Freddie, and you just kind of have to remember that once you get the information, it's probably pretty outdated. So Mortgage News Daily is a great place for that. All right, so let's look at the charts. If you're joining us for the first time, this is the mortgage-backed securities Fannie Mae coupon chart. We call these candlesticks, all the green and little red markers you see here. Think of this as like Fannie Mae stock ticker. It's not a stock. It's in the bond market as a mortgage-backed security. And I've highlighted there a couple of the major news dates. You go back to December 18th, which I believe was the last day we did a market update, but because we do it at 1 o'clock, the announcement and the chaos that sometimes follows isn't until 2:30 or 3 o'clock that day. But that was December 18th. I've marked that there with the Fed meeting. We saw a big kind of red drop there in the candlestick. And again, if you're looking at this for the first time, I keep it real simple. Down in red is not good for mortgage rates. Green and up is. And you're thinking, well, wait, I thought we want rates to go down. This chart is inverse to what consumers are offered in the mortgage space. So when we have red and down, the inverse that's happening out there to the consumer, rates are going up. Right? So we want to see more green, upward trend, and then we know the inverse that's happening in the marketplace. Interest rates should be coming down for the consumers. So we've had a pretty big slide there. And then it was like another BLS jobs report with a blockbuster number. It's unbelievable, like literally unbelievable. And we'll talk about the numbers that came out. But as you can see there, with that other big drop in downward red candlestick, That was January 10th, I believe. And that was just that kind of crushed us. Okay. Then, the following week, we got CPI, consumer price index, and we've got more of a favorable response, showing inflation has kind of stayed put, hasn't didn't get any worse. And what in particular stayed flat and caused that green candlestick to go up there was the fact that the core, which strips out food and energy, came in lower than expected. And that caused the bond rally market. The stock market even liked it that day. And now we're trending in these the last few business days. Obviously, no markets open yesterday with a holiday, but we've got we've got the 25-day moving average that we're just slightly above. Obviously, I'd love to see a move getting above the level R1 here, which is the black line, which is the 50-day moving average. When this ticker, right, when these candlesticks go above and below the 50-day moving average, they tend to hang out for a little bit, as you can kind of see here. When we broke through back in mid-December, we've been underneath all of this, right? It's been December was not a great month for mortgage rates for sure. And I don't know if you're seeing it, but you've got December holidays, general slowdown in real estate, and then you've got increasing interest rates. Mortgage applications were also lower than normal. But again, you've got seasonal and then market conditions kind of working against us here in the month of December. But what's great is this big black down arrow that we put here. We're above that. We've broken that trend, and now it's all about optimism and staying in that upward trend when it comes to this graph. Any questions on this, especially those of you that might be joining us for the first time and thinking, hey, what is all this little graph stuff he's got going on here? But those are kind of the big momentum shifters in the mortgage-backed security world. And again, this is kind of what I have up on one screen all day long, and keeping tabs on this as these economic reports come out. All right, so for the reports, since we last met, we did get the November PCE, personal consumption expenditure report. That's an inflation report. It is one that's closely followed by the Fed. They really pay attention to the core reading. Now, the headline reading increased by 0.1% month over month. It was less than expected, which was good. 0.2% than the two. They were expecting 0.2. It increased 0.1 to 2.4 year over year, which was also below the estimates of 2.5. So that was good for us. The core increased by 1/10 month over month, which was less than expected at 0.2, and remained flat at 2.8 year over year, more tame than the estimates of 2.9. Okay, so that was so muted because that was kind of like right in the middle of that downward slide. And again, since it beat expectations, but it didn't blow expectations away. Then we had the December ADP employment report on January 8th. Again, this showed some weakness. They were expecting 140,000 jobs created, and it was came in at 122. JOLTS is the job openings report. This one came in stronger than expected and pushed that number above 8 million. Markets weren't crazy about that, but those of you that have been along for this ride and come to these updates, you've heard me say that there's so much error in this JOLTS stuff because of the ability to work remotely, that companies can post a job, and if it's a remote worker position, each time they post it in any different state, it counts as a new job being created. So you've got data skewed there for remote worker positions that are advertised, and counted multiple times for whatever state they may be offered in. So that data continues to be skewed. And then the punch, the uppercut to the jaw was the BLS jobs report that came out. Again, if you've been with us, you know that I'm always skeptical of these readings. And they were expecting 160,000 jobs. And we got a blockbuster 256,000 jobs. Now, there's a lot of seasonal adjustments in that, but I guarantee you we're going to continue to see, just like we did for all of 2024, we're going to see downward negative revisions to that number next month when the January jobs report comes out. Now, unemployment. This, again, these are in red because I coincide that with the charts, right? That hurt, right? That was a big drop on that day, that big red candlestick on the chart. Unemployment also decreased a tenth, down to 4.1 when it was at 4.2. You've heard me say this before. What is going to change the Fed's approach to what they do to the federal funds rate? In order to go lower, they are going to have to see economic activity slow down. We're going to have to see lousy job numbers. We're going to have to see unemployment tick up. And, a lot in the industry, a lot of the economists, they think it's a matter of time that this is going to start coming out and catching up. Inflation has kind of taken a back seat because they've seen what they've done. They brought it down so much, and that's a little stubborn, a little sticky. But it's all about the year-over-year numbers that get replaced. When we get a new month, that month a year ago falls off the average. And we're going into, this month, January, February, we're going into some months where we are going to be replacing really high inflation readings from a year ago. And I think that's going to help the bond market. I think that's going to help interest rates. So stay tuned. I think, the earliest we see some reprieve and maybe some of this clarity is probably March. Then we'll have January and February's reports come out. I think some of this data is going to, hopefully show in our favor. CPI came out on the 15th. That was our big green candlestick. Now, it was mixed, right? The headline number went up, but the core came in cooler than expected at 0.3, right? Year over year decreased down from 3.3 to 3.2. That's what the market liked, because the market knows that a lot of the CPI data, right, and then some of the PPI data for the private sector comes in play when we get the PCE, which will be not this Friday, but the following Friday will be our December PCE. If that comes in full and as tame as CPI did on the 15th, I think we see a favorable reaction in the bond market and mortgage-backed securities. All right, that last week of the month is the Fed meeting. It's Tuesday and Wednesday, 28th and 29th. On Wednesday at 2 o'clock, they'll put out their statement. It's baked in. The expectation is they will pause at this meeting. They will not lower, they will not raise, they will just pause. But that then brings to the 2:30 press conference when Powell starts taking questions from the press. That's usually where the fireworks in the market start, because last meeting in December, he came off very hawkish, like the economy was booming, and there was, their rate cut projections. Remind you, they did them in September, and they were expecting maybe 4 to 5 cuts, at least 4 in 2025. And now that range went down to 2 or 3 based on the Fed members and their expectations of where they see interest rates going. September to December, right? That's only a few months. If we see some weak economic and higher unemployment in February and March, then by the next time they do their projections, which probably will be the March meeting, that could change again. And those expectations for lower rate, more rate cuts for the year could go right back up. Remains to be seen. We had kind of split market news there. Good, a little bit of good, and a little bit of bad, but man, the market took the good and ran with it on that day for mortgage-backed securities. Questions on any of the market news? So hopefully, we need a dovish tone from the Fed, not a hawkish. But I don't know. And what really drives me crazy about the timing of this, the meeting, right? They do their Fed meeting on the 29th. The next day, or in 2 days after that, is when the PCE inflation report comes out. Now, whether they're privy to some early data, who knows? They have some believe that they are. So, but when it's a key report like that, especially when they pay so much attention to the core rate, it drives me crazy when it's a few days after the Fed decisions. All right, we always look at the CPI chart. I wanted to point out, here, if the core reading for the month is 0.23, we talked about shelter. I'm going to show you we've talked about shelter being stubbornly and persistently high because there's a huge lag effect, right? And you've got rent, owner's equivalent rent, and lodging away. Rent is rent, right? Owner's equivalent rent is that goofy survey I told you guys about where they call homeowners and ask them what they think they could rent their home for. So just imagine the myriad of bad data they're getting from that. And then lodging away from home is your hotels, your Airbnb, short-term rentals, and things of that nature, which was horrendous for December. But all of these numbers, right, are moving down. And we think we're going to continue to see that. But of 0.23, almost half of it is caught up in shelter. This is why the inflation is so sticky. Used cars, airline fares, and motor vehicle insurance have been a thorn in the side as well. But now look at these readings. I mean, used cars down 3.3%. This motor vehicle insurance cut in half from some of the highs. This used to be like 22%. Now, it's the beginning of the year. A lot of people's policies flip, right, and renew. What are the premiums doing? We might get a little ding from motor vehicle insurance in the next report, well, February's report that looks back at January. Remains to be seen, but these numbers are minuscule down here to what they've been. And then everything else, right? Everything else that's not with food or energy stripped out of it, 0.02. That's the Fed. They crushed it there, right? We need to wait for this lag to continue. This number's got to continue to come down. And we believe it will. So speaking of that lag, finally found a decent chart that kind of shows that. So what I left here highlighted was the red is all items less food and energy. So think that's the core, right? For CPI, that's the core line. And then I kept shelter, which is the purple. So I wanted to, this illustrates the lag, right? So we see core peaks here, December 2022, and we've seen this downward trend here. We've seen this downward trend mimic, but again, the numbers are higher, right? So this is that lag effect that we're waiting. We want to see these numbers get closer and these lines get closer and closer together as time progresses. So that's been the one where we've had to kind of really pack the patience in. You guys may see it too. Rents being charged have settled down a little bit. I was a landlord in between tenants just in the month of November and December. Talk about an awful time to try and get a new renter in, right? And I just left the rent where it was for the previous tenant, right? And it still took we listed in October. It still took a month and a half to get somebody in there. So I'm living proof that I'm a landlord that didn't jack up the rent, because then it would just sit. All right. Any questions on CPI, inflation, jobs, shelter lag? All right, let's look at the locals here. And as always, these are the December reports for Northern Virginia and Prince William Association. Dulles area is always, I don't know what point in the month they must report their numbers towards the end of the month, because they're always a month behind when I go in to grab this data. But we'll start with Northern Virginia, median price 700,000, up 3.7% year over year. And that's pretty much it. I mean, Case-Shiller and some of these appreciation gauges are coming in around what, 4.3, 4.5 in that range. So not too shabby there. Total sales up 27.3% year over year. Prince William, median price 550,000, up 4.2% year over year. Total sales at 33.8%. And then Dulles, again, these are November numbers. Median price was 750, up 4.5% year over year. Total sales 17.6 year over year. Now, these year over year for price, right? I always kind of point these out. And if you're sitting there and you're courting buyers that have that mentality of, I'm going to wait for rates to drop, they're going to pay more for the house, right? And that these numbers show that, the appreciation is still there. Is it double-digit appreciation like 2020, 2021, and a portion of 2022? No, right? Is it more normalized? Yes. But I even hear some, clients, they read some of these doom and glooms like a housing market crash. We don't have enough inventory, right? Our demand is way outweighing our supply of homes, and that's going to keep homeowners who own, it's going to keep their values up, and it's going to continue to present a challenge for the buyers, especially in a higher rate environment where they're continuing to chase price. And as they wait longer and longer, they're going to continue, they're going to chase price. All right, we got some stuff in the chat here. Is consumer confidence low? That reading comes out this Friday, I believe. The Michigan University Consumer Confidence. I think that's Friday. It's been oddly high, in my opinion. So I'm interested to see. I'm pretty sure that's this Friday. With high interest mortgage rate, you'd think that renting a house will be faster. Potentially, I don't know. Like I said, it took me a month and a half to get, and it was crickets. I mean, we probably put it on beginning of November. Because I had some work done in there at the end of October. Beginning of November, and it was like crickets. And I thought, oh, this is not a good sign. I swear to you, the week after Thanksgiving, I don't know whether people just had to get through a holiday. Then I had like 6 or 7 applications that week. But yeah, I mean, rates. Thing is yeah, with if rents settle, right now we're battling that mindset from potential buyers of like, well, I might as well just rent. It's cheaper, right? But we got to you got to be an advocate for owning, advocate for buying, have a skill set to present the data to them, or at least get them in front of a mortgage lender who knows what they're talking about and can kind of show them the upside of buying, even in a higher rate environment. Right? Is if they can buy, previously we're an advocate for buying, because 3.7, 4.2, and 4.5 appreciation, that's a pretty safe bet that's going to continue, especially in our areas. Oh, Cindy, unmute to ask questions in the moment, please. Yeah, you guys, I'm not offended. You unmute, jump in with any questions that you have. All right, so on this note of thinking about the buyer, just within this last month, things are a bit slower. Still have pre-approved buyers out there. They're plugging away, but I see some of them losing, and I'm seeing some of them lose because I think they're making a fatal buyer error in their negotiation tactics. So those of you that work with buyers, I'll bring up this next slide. Right. Where, you know, buyers, they think they're getting a better deal. And sometimes their agents think they're getting a better deal if they start slashing their price. Right. Well, I'm going to offer them 10,000 below their asking price or 20,000 below their asking price. Give them a real low ball offer just to see how motivated they are. That is from what I've seen in the last month. That comes back with counter offers. That will eliminate things or cut in half the request for seller subsidy. And for you agents, now you're writing in your buyer's commission that you're trying to get the seller to pay. They're slashing right back at your commission. I've always felt, provided that appraisal is not going to be an issue, that, you know, and comparable support, that the strategy in a slower market is to give them their price, but try and negotiate the credit for the buyer. And this chart illustrates this. If you start on the left-hand side with me over here, right, $333,333 purchase price, 5% down. The borrower's going to finance almost 317, markets at 7%. Payments 25.45 on this house, and it's a little over 27 cash to close. Right. This next column is the buyer that says, I'm gonna offer them 10,000 less. Okay, you can do that. Yes, you're financing a little bit less, but your interest rate's still 7% here. Your payment only dropped $65. Cash to close went up. So the thought here is, well, if you think $10,000 would be more beneficial to, let's say, help you buy your interest rate down, or absorb your closing costs, the amount of your own money that you have to put in as a buyer, could go much further. So I always show kind of like a buy down. Now this is a 2-1 buy down example, right? So you give full price offer at 333. You ask for the $10,000 in seller credit, okay? Or you utilize a credit to do a 2-1 buy down. And what that does, for those of you that don't know, in a nutshell, you take a 30-year fixed rate loan. In the first year, the interest rate that the borrower will make payments on is reduced 2% from the note rate. So for this example, the note rate's still 7, just like in columns 1 and 2, right? But year 1, their payment will be based on 5%. And then in year 2, the interest rate will go up to 6%, and their payments in the second 12 months of the loan will be based off of the 6% rate. And then years 3 through 30, right, will revert back to the original note, which was 7%, and remain there. Right. So it gives that's a 2-1 buy down, but you can do a permanent buy down. Hey, ask the lender, hey, I've got a $10,000 credit. What could I, how much lower could I go just permanently buy down the rate? Right? How much better in rate can I do for this $10,000 that's coming from the seller? Right? So you can do that as well. But I mean, just in year 1 though, no, we've got a huge affordability problem, 406. Now, keep in mind, the borrower must qualify at that higher note rate of 7 for this, right? And again, any good lender, if I'm working with these buyers, I'm making sure that, hey, in your worst case, you don't have an opportunity to refinance this, or you don't sell before year 3 starts. You have to be comfortable with that payment that you see over here in the first column, $25.45 a month, right? You're not going into this without knowing that you can do that, right? Puts you at risk. But helps out in the affordability piece without a doubt. Okay. So I always show kind of equivalent. What kind of low ball offer would it take to save $406 a month off that 333 price. You'd have to go in and offer 270. Obviously, that would be super insulting to the seller and listing agent, but that's what it would take to get the buyer to 2139 a month. That's the low ball offer equivalent, right? So the message here, you're working with the buyers, right? Make sure that they're educated on something like this, where, hey, the 10,000 that you're trying to cut off price might be more beneficial in you in terms of a credit from the seller to go towards closing costs. We're looking at doing a buy down loan to kind of give you some reprieve on rate and payment, because again, the buyer's pinch is in affordability. Sandra, why is the cash close higher in second scenario where the price is reduced by 10K? Not sure exactly. There's probably something in there, and something might not have transferred over correctly. I'd have to look. It's the honest answer. I'm not sure why. Great chart. Will we get a copy? Yeah, you'll get, those of you that are here, you'll get the slide deck for sure. But yeah, this is keep this in mind. I felt like this was topical right now. My buyer clients, when they come in, right, the agent calls me, hey, they want to make an offer, but they want to go 10,000 less. And I'm kind of like, wait, give me a chance to put this together for them, put it in front of them, and see if it changes their mind, right? 10,000 less to save $65 a month. I could save $65 a month with one less meal out somewhere. That I need the needle to move a little bit more than that. So it's our jobs to help buyers kind of see this, right? Because they think they're getting a good deal by just cutting price. Any questions? Comments?
Thanks for walking us through that. That was great example.
You're welcome. You're welcome. Well, that's all I've got for this month's update. I appreciate you being here, and please continue to join us as we do this each month. I want to help keep you guys kind of informed on, what's going on out there. And when you hear about rates going up, I like to think I give you more of the behind the curtain explanation than what the frontline media might be doing out there.
Well, thanks, Mike. Thanks, everybody. Oh, he wants to, Marianne wants to, do you service nationwide or only the DMV area?
What's that?
Do you service nationwide or only the DMV area?
So DMV area, it's I can't answer. It's not that. It's not nationwide. It's Marianne, I can give you it's state, right? But for all intents and purposes, I operate and can lend. If you think of the Eastern Seaboard, right, from Delaware down to Florida, we got a few weird ones like Alabama and Tennessee, and we do West Virginia and Pennsylvania, but nothing further north than Pennsylvania or Delaware. We're not in New England, but that's the easiest way to describe it.
All right, they can always call you. All right, guys, have a great day.
All right,
Thank you
guys.
so much.
Thanks, Mike. All
All right,
righty,
take care, guys. See you next month.
take care. Bye.